Welcome to Money Mavericks, the podcast where we explore the dynamic world of finance, investment, and entrepreneurship.
I'm Kirk Drake.
And I'm Darryl Hicks. Together, we're here to bring you the latest insights, expert opinions from the trailblazers who are redefining success in the financial world. One of my favorite books that I've read in the last couple of years was Morgan Housel's Psychology of Money. And human beings, unfortunately, do not act rationally when it comes to money, right? It would be really nice if everything just lived inside of a nice, neat little spreadsheet, and then we could take all the emotion out of decisions. But it even kind of relates back to what we were talking about before when we say like human beings really don't want to move backwards. Once someone's used to having access to cheap money, free money, and they can use that to supplement their lifestyle, they want to be able to keep going to the restaurants, Monday to Thursday, right? Which, by the way, I think it's fascinating that you are sending people out and looking for that kind of data. Like there's a real curiosity that's implied in that, which I think is probably one of the, from a first principles perspective, that's probably what allowed you to get out there and get a better understanding of what's going on in the economy. First of all, you are better positioned in the credit union. Like you said, you get early access to data before the reports come out from the Fed and from the government, right? You get to see it earlier, but even just not relying on your own data and using it wisely, even sending people out on the streets and say, hey, let's go see what's going on at the restaurants. Let's look at car loans. Let's look at mortgages. Let's look at everything. I think that that's incredibly fascinating and a lot to unpack and learn about that. Go get your own data. I've got a beef with CPI, for example, because the way that this has been so terribly manipulated, it's been politicized, right? And even there's like perverse incentives, like the more, because, Social Security and so many other things are tied to core CPI and COLA adjustments, there's this perverse incentive for them to push down the number and make it seem like inflation's actually lower than it is, because the higher they report on inflation, the more Social Security payments are going to have to get adjusted up. But the reality is everybody knows inflation is way higher than the core CPI number that's coming out. And so if you haven't adjusted salaries and Social Security, that means that actually people are getting squeezed and they're having to make do with less, which they don't want to do. And they're not going to act rationally, which means they're going to use their credit cards and their HELOCs to try to supplement it. And then around we go and inflation stays stubborn, right?
And to your point, I remember during the last tightening cycle, the big thing was Larry Kudlow had come out on CNBC. He was still there at the time. And he was talking about hedonic adjustments, right? And who was the money manager at PIMCO back then too? You remember the big bond guy. What was his name? Bill something. I don't know why I'm drawing a blank now, but there forever ran the PIMCO real rate return fund and actually had some
Bill Gross.
Bill Gross, thank you. Yes,
yeah, Bill Gross.
He was phenomenal, and I always enjoyed his commentary because he always start with a story about some random movie and somehow work that into economics. But he talked about they're talking about hedonic adjustments in CPI. So like you buy a new car, right? And so the new car has a better GPS system. It has seatbelts that are more safe. It has more airbags to keep you safe. But that car costs $15,000 more. But with the adjustments, the car is actually cheaper. And so it actually shows like prices went down. Well, you can't buy the car without airbags. You can't buy the car without those safety checks. And so now, it's not capturing, to your point, that $15,000 more that car now costs. They're saying that because of this technological innovation and advancements, you're getting a different product, that it's not really inflation.
Which is a fair and logical argument, yet when magnified, it's sort of like cost accounting. If you allow it to change more than once every 5 years, all you're doing is gamifying it within the business and politicizing who's paying for what. And I'm always in the camp of like, you can do it. You got to run with it for a period of time with no changes and just accept it as it is. Every so often, you're allowed to make changes.
How do you do adjustments with eggs? Like, it's an egg.
Well, but an organic egg, has more calories and is better for your health. And if you look at it, people who are eating organic, free range chicken have lower cholesterol. You can make these arguments about anything, but I agree with you. At the end of the day, as a consumer, I can always just go back to egg, right? And at the same time, I don't know about you, I have upper limits of things. Or I say to my wife, is like, look, I'm just not paying more than $6 for a dozen of eggs, period. I don't care what they do to the chickens. At the end of the day, my limit is $6 for a dozen eggs.
$9 for bacon. That's it. Yeah. No.
Yeah.
I like
I
eggs
think
though. That's the problem, you know?
I agree.
Yeah, and you're not alone in that. And that comes back to, like, one of the other points that kind of came up for me as you were going through this is that, you know, the government, the Fed thinks that they can cool down inflation, they can raise rates and stuff like that. I think everyone maybe underestimated how persistent the desire for human consumption and for maintaining quality of life was really going to be. And ultimately, when you're raising rates and you're saying you want unemployment to go up, what does that mean? It means that companies are failing, companies are struggling. There is a tremendous amount of emotional pain and resistance around this. Like, I can tell you, even talking to like my fellow CEOs, like, it's amazing to see how quickly the tech industry, my industry, has really responded, and how quickly people found religion around extending runway and making cuts. But I can tell you, it's some of the most painful and trying stuff. And it's really hard to cut as deep as you should anyway. And then, but just think from a human suffering perspective, everything that's going on in that, like the debt loads on credit card debt, the frustration that you see, what that even means for like society, and the tension and the stress and things kind of boiling over. Like, if you had a crystal ball kind of looking at this right now, how do we unwind this and get out of this? Because if the consumer does start to break, and if credit card debt gets to a huge point where it's just ballooned like mad, what's it look like as we wind our way through this?
We talk about the mental health issues going on in the country. This is going to compound those issues.
I think you're right.
It's unfortunate. And hopefully companies that are like credit unions that are not-for-profit financial cooperatives are going to really take a bold stance in helping their members through tough times and making sure that their team is prepared to have conversations. They're future prepping the organization to prepare for some volatile times too, so that they can be sustainable. I don't really have an answer. Have you read the book Affluenza? It's a little bit older book, but it's a really good book about,
Love the name.
yeah,
It says it all.
it does, right? And so the book goes back and does some historical data points. And so I may get the year wrong. I'm pretty sure I'm close. So we'll give or take a year. Like 1957, the average home in the United States was something like 750 square feet. And today it's over 2,100 square feet. And so you can kind of say, look at the size difference of how things are changing. They reference a happiness index in the book. It's not something that I track, so I can't speak to where it is now. But at the time of the book was published, the highest point of the happiness index that they tracked, they reference in the book, was 1957 as well. And so they continue to use the same data point. But what happened then was it was the year the first commercial aired. And so as people now found out about things that they didn't know that they wanted or needed, they now felt less happy because they needed to go get those things. And so it's a fat 2 point. The psychology of this is just tremendous. And where this is going to stop, I don't know. I mean, I think the effects of social media, the amount of messaging and things that are thrown at us. I mean, before you might pass a billboard or watch a 30-second commercial, but now people on social media, I think the last time I saw an average person is going to spend over 3 hours a day on social media. I like to sleep a little bit. I need some rest. I don't know what people
And all we're making you do is feel bad about decisions and the perception of other people's lives.
Yeah,
right?
we've seen these reports.
Yeah,
we've seen these reports and these charts. Like, what apps on your phone make you feel happy after you use them, and what apps on your phone make you feel sad or frustrated or, upset, emotionally distressed. And it's unbelievable. Like, I got a kick out of this. One of the apps that makes you happiest is your calendar. It's the one that you spend the least amount of time in, but it's one of the ones that correlated the most to happiness and satisfaction. And unfortunately, the ones that create emotional distress are the ones that were the most consumed apps on the phone. We can't help ourselves, though, as human beings, unfortunately, getting pulled into these things. And, not to be overly philosophical on this, but I think that if you have little kids and you try cutting a cookie in half in front of 2 3-year-olds and give one of the 3-year-olds the smaller half of the cookie, just watch what happens.
Oh, there's a Instagram feed that is purely people trying to cut things in half perfectly.
Yeah, so this stuff is deeply ingrained inside of human beings. Like,
and you can see people like losing their mind over like watching someone else cut a carrot in half that you're never even going to have either half of.
They probably have 30 million followers. And yeah, I'm curious now, is there an EQ tracker in the world? Did we track EQ? I mean,
emotional intelligence or happiness tracker?
Yeah, I think more EQ than happiness, because are people aware? If we don't become self-aware of where we're at or our habits, I think that's the first step to change, right? So self-awareness, and then you can go into self-monitoring and self-regulation, and then you can go into change, but sustainable and permanent change, right? Not just, I'm on a diet this week and I make it one day, And so I don't know, it'd be interesting to see. I'm curious
It
now.
reminds me of the marshmallow test that they ran back in the 70s, right? You can have a marshmallow now, but if you wait 15 minutes, you can have two.
Yeah.
And the kids who were best able to self-regulate and wait the 15 minutes to get the second marshmallow had way more happiness, more successful relationship.
On Money Mavericks, we don't just talk about making money. We explore the innovative strategies and bold decisions that drive real change. Whether you're an experienced investor, a budding entrepreneur, or just someone looking to make smarter financial choices, we've got something for you.
Every week, we're going to sit down with industry leaders, visionaries, and mavericks who share their journeys, challenges, and breakthroughs, from contrarian views on market trends to the secrets behind building a successful startup. You get an inside look at what it takes to thrive in today's economy.
And we promise to keep it real, engaging, and most importantly, actionable. No jargon, no fluff. Just straightforward conversations that you can apply to your own financial journey.
So get ready to challenge your thinking, expand your knowledge, and take control of your financial future. This is Money Mavericks,
where we turn financial dreams into realities and mavericks into legends.
There's a whole other study that just proved that completely not true. So
I don't know, man. I think the idea is still.
I agree with the
sound.
idea.
We know that we know this to be true, though. I mean, I'd almost wonder, like, who debunked it? Was it the people that want us to buy more stuff?
Yes, it's a Nabisco.
The marshmallow people. They're like, no, you need to eat more marshmallow.
No, you need to eat the marshmallow. You need to eat it now. And again, there's a couple of other, like, more nerdy finance questions that I really want to get to and ask you about. But I think that, human beings, unfortunately, don't always act rationally with these things. I love this point. I hadn't heard that before. It makes total sense. Like in 1957, when commercials come out, now all of a sudden people aren't happy because they realize there's something that they don't have that they want to go get, right? But our ability to self-regulate and control that is probably the way that we escape some of the pain.
If you look at the average individual investor, their long-term rate of return in their investment portfolio is like 1.9%, when the S&P 500 is, something like whatever, 8-ish, right? And so all you do is buy an S&P 500 stock index fund, and you'd outperform by 4x. And it's because of, obviously there's a lot of biases, but it's emotional.
I'll give you a perfect example. So I have a financial planner that we started with when our twins were born. So I'm a good 13, 14 years into it. He's got maybe 20% of our net worth, but it's a sizable amount, right? And he's got it in some BlackRock fund that has a lower beta, all the normal garbage you hear. And every year I ask him, yeah, but the S&P 500 over the last 13 years is still kick your ass, right? Like, why should I keep this money with you?
It's like that BlackRock Global Allocation Fund or something.
Yeah, I mean, just whatever it is, it's garbage, right? We didn't expect that volatility. We didn't expect that shock, right? I'm 100% convinced that the rational, smartest thing I should do is take the money out of his hands and put it in an S&P 500 fund. And every year we have the meeting, we have a nice conversation. He asks me about the kids and gives me some advice about something else that I rationalize. I think the latest is they're going to order their clients. They send out customer gifts or whatever. They're sending our wine, right?
Oh, nice.
So I was like, okay, so how do I factor the cost of, like if I'm selling a bunch of wine through this, where does that factor in this return? And at the end of the day, I know the decision I should make is to take it out and put it in an S&P 500, and I cannot get myself to do that. How do we overcome that? What is the thing that gets us to actually make that tough decision, switch it, and move on?
I think your risk aversion is obviously, even accepting lower returns might be acceptable because of the amount of wealth you've already accumulated. You don't need bigger returns to get there, right? I mean,
sure.
You see that phenomenon. People get more risk adverse as they accumulate more wealth.
Which is the reverse time to do it, right?
Like, yeah, it's the reverse. Yeah.
Yeah. But like, even when I was early on, like I remember I was always more conservative than I should have been. I should have been more aggressive. But you think about what informed us, at least me individually, right? So the tech wreck, 9/11, the Great Recession, right? Those
we've seen crisis after crisis. Right?
Yeah, it was. I think that there's a reason for it. I guess I can explain it away, but at the end of the day, I should have taken a long-term view and been on it. But it's a good point.
Kirk, do you want your go-to for financial advice and why?
I think from a financial advice perspective, I mean, obviously we have our financial advisors, right?
Do you feel like a Ray Dalio or like
I really enjoy the American funds, the Capital Group money managers. And the reason why I go there is, and this is for personal financial,
Yeah.
they compensate their money managers differently. So they have portfolio managers, instead of having one all-star portfolio manager, they have like 8. And then they give one slice of the pie to the analysts too. So analysts are making calls too. They're like, hey, the managers don't want to take this. I did the research. I was on the floor. I was there doing the questions. I really like this. I want to add it to the portfolio. They do. And then they don't compensate their managers based on annual returns. They look at rolling 10-year returns. And so long-term performance is really strong. So I think that they get less caught up into the fads and more look at long-term trends to get to their conclusions and their recommendations. And so that's why I enjoy them so much.
If we go back to starting with compounding, why are we looking at anything other than something that encourages compounding?
For just like the contrarian in me that likes to hear the upside down thinking happen and not just the popular stance at the moment, the consistent stance, if you would. Dr. Lacey Hunt at Hoisington Management. This guy is a gem. I mean, he is gold. And sometimes I'm like, should I share his name? Like, I don't know how other people know about him, but he's brilliant. He's based in Texas, and he's an economist that is actually managing money. So he's not just, somebody that's just giving forecasts. He's actually placing investments and bets around what he thinks is going to happen. And he manages a long duration treasury fund that has outperformed the S&P 500. And I don't know exactly the exact stats, but it's like something like 22 of the last 30 years. So pretty impressive when you can take treasury securities and outperform on a total return basis relative to the S&P 500. And so the data he provides, everything else, like, he looks at the things that other people don't look at, like the effects of the tax multiplier, the effects of the GDP expenditure multiplier. So one of the things he brings up that he's always likes to talk about is the headline talk is, let's take on some debt to stimulate the economy, and then we'll have output and increased GDP, right? Common sense, right? That's what people say. Well, he goes back to the original points of data, and he says, it's called the GDP expenditure multiplier. If you look at the exact stat. And so he'll say, when we first took on debt, we were getting $5 of GDP for every $1 of debt we were taking on. Today, for every $5 of debt that we take on, we get like 14 cents of GDP. And so it just doesn't work. And same thing with tax multiplier.
Well, this is like anytime you get government spending over a certain percentage, it doesn't accomplish anything, right? So
when you look at some of the stuff, it's like, wow, this is it's data that challenges like, headline thought when you don't get down, when you're surface level versus, let's say scuba diving, right?
Right.
So you get down deep in that data, and he does that, and he provides the charts and the data points, and it's less about like, emotional kind of forecast versus, hey, this is where the data is, and this is what I think is going to happen. I'm not saying he's always right, but he is interesting to read because it's just so different than anything else you're going to see in the market.
It's fascinating. I know we're coming up on time, and you've been very generous to give us the time that you already have, David. Maybe we'll have to have you on another time. We can kind of geek out on some of the other stuff, because I know that one of the things you really looked up to in the industry is the way you manage liquidity ratios at university, current ratio, quick ratio, cash ratios, and the way you've kind of managed all of that. And that's super nerdy and geeky, but I'd love to unpack that
deep dive
time.
Dr. Tuyo on liquidity ratio. And I look at the numbers, and you guys had a small one.
Yeah. I mean, we're doing well, and the Creighton's doing well. We continue to perform. We're a growth-oriented company, but maybe we can talk about the coefficient of determination too. It's probably my favorite one.
Oh man, let's go.
So it's all about trying to isolate the variability from an independent variable that causes the variation of a dependent variable. And so you think about how that statistic can be applied. No one uses it enough in our industry. In fact, when I talk about these things, no one really like, oh yeah, David's talking again. But I mean, in all seriousness, like, I think it's a tremendous statistic. If you can isolate and understand what causes the variation, then you can get ahead of everybody else. And so there was an article from Filing, and I don't remember the exact year, 07, 09, somewhere in there. And it was talking about that credit union performance, bank performance at the community level and regional level and smaller, right? So kind of the small, mid-sized financial institutions, 74% of our performance is based on macroeconomic reasons. We can only impact our ratios and our performance by 26%. So anytime there's a large delta out there where somebody's outperforming versus peer, or somebody's underperforming versus peer, that 26%, that can play like a really large number. So how do you get ahead in there? How do we make sure that we find ways to outperform in the metrics that we find most valuable to our member owners? And that could be in, member give back, it could be in member savings, it could be in rate, it could be in fee, it could be in service, it could be in expertise, it could be a variety of different things. But, for us, our core focus is around making sure our members have affordable transportation, affordable housing, and that we teach them about upward mobility through managing their credit and their daily budgets. So it's exciting stuff. And so maybe you guys can jump into coefficient determination. I think it's a great stat. And I think there's a lot of ways that you can apply that.
I'm going to go do some research on this. Yeah. And I think for the people listening who are, sitting in roles similar to yours, I hope they take that really seriously and go explore it a little bit more. And we'll definitely try to have you back at some point. We can kind of dig into some of these things a little bit more deeply. Yeah. But the one takeaway that I got from this conversation is that your curiosity and passion for going out and getting the data, and like you talked a few times about the contrarian point of view and contrarian sources of data, and the curiosity to apply it is really exciting and compelling. And I think that's probably from a first print. I'm always like trying to like say, what's the lead domino that if I had this thing, it would make everything else easy or irrelevant. And that to me is yours, like having access to some of this hidden data, but then the curiosity and the spending the time to really analyze it carefully. And it's great that you're doing what you're doing, sitting in the seat that you are, because now there's so many other people that are so positively impacted from the skills that you're bringing. So super fun conversation, man. Really, I appreciate it. Really love it.
I thought you were going to say that the key was Kirk Drake, but I mean,
yeah.
But I really enjoy the conversation. It's always fun. It's not always do we get a chance to kind of take a break from the day and kind of get a little heady around things. And so it's really a lot of fun to kind of geek out on these things. I appreciate the opportunity and really enjoyed the time. It was a lot of fun. It flew by.
Same here, buddy. Thanks a lot.
Thanks again.
Thanks for tuning into this episode of Money Mavericks. We hope you found it insightful and inspiring.
Don't forget to subscribe, like, and leave a review on your favorite podcast platform. And be sure to share this episode with someone who needs to hear it.
Stay connected with us on social media and visit our website for exclusive resources, episode transcripts, and more.
Until next time, keep pushing the boundaries, making smart moves, and turning your financial dreams into realities.
You've been listening to Money Mavericks, where Mavericks become legends.